We're going to be beginning in just a few minutes. Thank you for attending. We're just waiting for everybody to join the meeting. Good afternoon and welcome everybody. We're so glad that you can be with us today. Hope that you are healthy. And we know that there's a lot of questions going on about what's happening with your business and your family and your financial future. And the US government has provided some guidance for all of us on how we can weather the storm financially. And I hope we'll be able to answer all of your questions. I want you to note that on the opening slide towards the bottom, it says that this was presented on April 2nd of 2020. And I can tell you as early as just a few hours ago, we've been making. I want to go forward with our presentation and just let you know that we have a little disclaimer to share with you, just to say that because things are changing so quickly, we need to just let you know that there is a potential that information that we may provide may not necessarily be accurate tomorrow or in the next hour, but as of this moment, the information we're sharing is that we'll be able to understand a lot more about what's happening and be able to use the information we're providing today. We understand that there'll be a lot of questions through the presentation, and we hope to answer as many questions as we can when we have completed. So I just want to introduce to you the speakers that we're going to have for today. Besides myself, David Goodman from LB Goodman, we also have Kathy Murata, Jackie Shami, directors at the firm. We have Sean Brahini, who is a principal at the firm. We also have Susan Jacobs, who is our tax manager. And we are joined today by Joe Quinn Espinal, who will be able to give us some insight in the fast-changing application process and what's happening behind the scenes between the banks and the SBA. We're going to try and do our presentation in chronological order of how the legislation has rolled out. And our first speaker is going to be Kathy Murata. So I'm going to have Kathy take over the presentation from here and share with you the Sick Leave Act. Kathy.
Thank you, David. Good afternoon, everybody. The Families First Coronavirus Response Act, which went into effect yesterday. The act does not replace current sick leave policies or the current federal Family and Medical Leave Act. Coronavirus issues. The act consists of two parts, sick leave and the expanded Family Medical Leave Act. I will be primarily addressing the sick leave part of the act. The paid sick leave and the expanded family and medical leave provisions apply to certain public employers and private employers with fewer than 500 employees. The act entitles eligible full-time employees 80 hours or 2 weeks of paid sick leave. It also entitles eligible part-time employees to paid sick time for the 2-week equivalent. For example, if a part-time employee is scheduled to work 20 hours or averages 20 hours a week, that part-time employee would be eligible for 40 hours of paid sick leave over a 2-week period. There's a chart on the screen. It's 1 through 6. 1 through 6 are the conditions that an employee needs to have to be eligible for the sick leave. I'm going to address the first 3 now. The employee is subject to federal, state, or local quarantine restrictions. The employee has been advised by a healthcare provider to self-quarantine due to COVID-19 concerns. The employee has COVID-19 symptoms and is seeking medical diagnoses. These employees would be entitled to 100% of the higher of the regular pay or federal or state minimum wage, $511 per day, and $5,110 over a 2-week period. These limits would be prorated for part-time employees. Now I will address 4, 5, and 6. The employee is caring for someone under quarantine or self-quarantine. The employee is caring for a son or daughter if the school or daycare provider has been closed due to COVID-19 precautions. And then they're assisted by the Department of Health and Human Services. These employees would be entitled to 2/3 of the higher of the regular pay or state or federal minimum wage up to $200 daily and $2,000 for the 2 weeks. Again, part-time employees' paid sick pay will be prorated as to the average hours worked. The good news for employers is that they will receive a reimbursement for all paid leave, including health insurance costs. The reimbursement can be quickly accessed through credits against payroll taxes. Employers deposit payroll taxes, which consist of employees' federal withholding taxes, Social Security taxes, and Medicare taxes, plus the employer's share of Social Security and Medicare taxes. Employers need only deposit the excess over the sick and family medical leave payments made for that period. For example, if your payroll tax deposit amounted to $10,000 in a period, but you had paid out eligible sick and medical leave payments of $8,000, you would only need to deposit $2,000, therefore keeping the $8,000 as a reimbursement for the sick pay. However, if the reverse is true and the payroll tax deposit was $8,000 and you have paid out $10,000 in eligible sick and medical leave payments, you do not need to make that deposit and can request an accelerated payment from the IRS. IRS is expected to make payments within 2 weeks. We do not have the details of the accelerated procedures as of yet. Now you have to be careful because there are penalties. Employers in violation of the first 2 weeks paid sick time or provisions of the Extended Family Medical Leave Act will be subject to penalties. These penalties are stiff. Department of Labor will be issuing a temporary non-enforcement period for the first 30 days that provides a period of time for employers to come into compliance with the Act, so long as the employer has acted reasonably and in good faith to comply with the Act. However, Small business exemption from the requirement to provide leave due to school closings or childcare unavailability if it would jeopardize the viability of the business as a going concern. And remember, the sick leave does not carry over from one year to the next. The 80 hours of sick pay does not count towards other sick day or leave policies. Sean will now speak about the Expanded Family and Medical Leave Act. Sean?
Good afternoon, everyone. Like Kathy said, I'm going to talk a little bit about the Emergency Family and Medical Leave Expansion Act, which is also put into effect yesterday. This applies to employers with fewer than 500 employees. Now, we don't know whether or not this is going to be by employee identification number, whether or not controlled group rules apply. We just don't know yet. That's a little subjective. So when we have updates, we will share them with you. This act also applies to employees who have been employed for at least 30 days. It amends the Family and Medical Leave Act, the FMLA, as you now know it, to provide up to 12 weeks of leave because of a qualifying need related to a public health emergency such as COVID-19 pandemic. So a qualifying need arises when an employee is unable to work or telework in order to care for their underage 18 child because the school, place of care, or child care provider has been closed or is unavailable due to the COVID-19 emergency. Now, it's important to remember that the first 10 days of this leave are unpaid. However, during that 2-week period, the employee may elect to take other types of paid time off that are available to them, whether it be accrued vacation, paid sick time, or other paid time off, or time that may be covered under the emergency paid sick leave, as Kathy discussed. After the first 10 days, the employer will provide mandatory paid leave for each day of leave up to the remaining 10 weeks allowed. The paid leave amount is going to be 2/3 of the employee's regular rate of pay based on the employee's normal work schedule. Now, this amount is going to be capped at $200 per day and a total of $10,000 in aggregate for each employee. Now, it's important to know that employers with 25 or more employees must restore the employees to their positions following their return from leave, just like the FMLA rules as they currently are. Employers with less than 25 employees must also reinstate their employees unless certain conditions are met.
Okay.
Now, there are special exclusions for healthcare providers, emergency responders, and businesses with fewer than 50 employees whose businesses could be in jeopardy if they were forced to comply with these provisions. Now, lastly, there are limited tax credits available for this to employers. Essentially, it's a dollar-for-dollar reimbursement through tax credits for qualifying wages that are paid up to the caps we discussed above. And just like wages, these credits also extend to benefits such as health insurance. So now we're going to move on to Susan to talk a little bit about the EIDL loans.
Hi, everyone, and thank you for attending this webinar today. I'm going to talk about the Economic Injury Disaster Loan Program, which is administered through the SBA. This loan is on a first-come, first-served basis, and I highly recommend that you all apply online as soon as possible if you have not already done so. Who can apply? All small businesses with less than 500 employees, including sole proprietors, nonprofit organizations, as well as independent contractors. And even if you were not in business the whole entire year during this time frame, you still can qualify. With this loan, you can receive up to $10,000 in emergency funding and receive this via direct deposit to the bank account that you provide in the application process within 3 to 5 days. And just know that this emergency funding does not need to be repaid. But also know that this is just the beginning of the process. the SBA will get in touch with you after they review your application and may request some additional information to determine the actual amount of the loan that you qualify for. The maximum amount of the loans are up to $2 million, but those are based on the size and type of your business. The interest rate is set at 3.75%, and for nonprofits, it's 2.75%. This loan also has approximately 30 years to repay, but this also will be determined on a case-by-case basis. Just know that the initial funding, the emergency funding that you receive, does not need to be repaid, but if you receive an actual loan through this program, there is no loan forgiveness for that part of it. We also believe that there's potential for additional funding, but we don't have that information yet. And just know if you apply for this, it will not impact your ability to apply for the PPP loans that David will be discussing in a little bit. What type of expenses does this loan cover? Basically, all your business expenses, including rent, utilities, payroll, and any other working capital needs. We also believe that this loan will not impact your ability to receive loans through the NJDEA or any New York or New York City agencies. Just want to let you know that the application process is fairly easy. They have simplified it. I just want to go through quickly a few key items that you should have with you when you go to apply for the loan. So you will need your business's gross receipts from 2/1/19 through 1/31/20. And don't worry if your books are not complete for that time frame. You could always just take a look at your bank statements and add up your deposits. They also ask for cost of goods sold if applicable. Just know that for dentists or doctors or other service type businesses, that is not applicable. So you would just need to put 0 in that box. Some of the other required information is the date that your business began, as well as the date of the current ownership of your business. And this one is important to have this information with you when you're filling out this application. If you have more than one owner of your business, you will need all of the following information for each of the owners. Each of the owner's full name, address, social security number, date of birth, place of birth, if they are a US citizen or not, and their title. So if you have not done so yet, I highly recommend it that you go online and apply for this loan for your business. And now David will discuss the PPP loans.
Thank you, Susan. Oh boy. So if we haven't confused you yet, now is the time. So this has been going on for about 20 minutes now. And this is a big portion, I'm sure, of what a lot of you have questions on. And unfortunately, I wish I had all the answers, but I don't think anybody has all the answers right now. Things are changing so quickly. Just to give you an example, last night, we were notified by the ADA, the American Dental Association, that the Treasury had decided that small businesses with less than 50 employees can find ways to possibly be exempt from family leave. We were expecting applications to be available today for this PPP loan. Some banks are saying they're available, but we believe that the final is not. And we'll have Joaquin, who will be able to give us some more insight into that. So we're going to talk about the Paycheck Protection Program, also known as the PPP loan. And this is the loan you might hear of with forgiveness. So let's kind of get a little understanding of this, and then we'll talk about some strategies about the PPP loan. First of all, this is a loan that's to employers to maintain their payroll during this emergency. And so they're just trying to get people off of unemployment, get them working, get them their benefits. This applies to businesses that have no more than 500 employees. Now, there is attribution rules here, which means that if you have more than one company that has common ownership, then all of those companies are pooled together to determine the number of employees. There are exceptions, though, to franchisees, as well as exceptions to hotels and like large restaurants and catering facilities. It applies to almost every type of entity, which includes sole proprietorships, independent contractors, and self-employed individuals. And it is also available for not-for-profit organizations. The business must be in operation on February 15th, 2020. That's the beginning of the qualified date. And it would also need to have payroll, somebody being paid. So a rental property would not be something that we would look at unless they had payroll. The maximum loan is going to be $10 million. And some of or all of this loan can be forgiven without any tax implication, because typically forgiveness of indebtedness is a taxable event. However, in this case, not taxable. Now, we also have the determination of the amount. So if you were in business from 2/15/19 to 6/30/19, your maximum loan is 2 times the average monthly payroll cost. We'll get into what the definition in the bill was for payroll costs. Just an aside here, the act that we're discussing has 880 pages to it. So there was a lot of information to digest and a lot of things, believe it or not, in 880 pages that were left out. But we're trying to get clarification on all of that. So if you were not in business for the period 2/15 to 6/30/19, the maximum loan is 2.5 times your average monthly payroll cost for the first 2 months of 2020. And that includes leap day, because there was 29 days in February this year. Now, if you took out an emergency industry disaster loan that Susan just spoke about, between 2/15/20 and 6/30/20, and I know many people have applied, and I don't know of anybody yet who has actually gotten the grant money, but it's quite possible you could get that money between today and June 30th. The balance that you borrow from the EIDL loan would be added to the loan and is refinanced into your PPP loan. However, the $10,000 grant is not considered part of the loan, but it is also not going to be considered part of the forgiveness. Now, how do you figure the payroll cost? Well, let's give you the elements that the bill tells us are part of the payroll cost. First of all, you have compensation, which includes salaries and wages and tips. You have paid time off. So if you paid anybody for vacation or family medical or sick leave during that year or that time period that you're calculating your payroll cost, that would be included. Also, payment for group health care benefits, including health insurance premiums, would also be part of that calculation. Payments to retirement plans, the employer portion we're talking about here, so not the employee elected deferral, let's say on a 401k, but the portion that the employer contributes. For example, we're talking about safe harbor matches, we're talking about simple IRA matches, or even a profit sharing plan or a SEP plan contribution for employees. Now, we're not quite sure if these are going to include accrued payments or they're actually cash payments for these benefits. But the law says that it would be incurred and paid during the time period. So it's kind of confusing. We're looking for clarification, but at this point in time, we're going to assume that if during the period of 1 year that we're looking at with a retirement plan, we're going to assume that the prior year's contribution would be paid in the current year, and we would use that as part of the calculation for the payroll cost. In addition to that, we'd also have the state and local taxes that are assessed on wages. This is typically state unemployment insurance, as well as short-term state disability premiums and family medical leave insurance. And an obscure provision that many of you probably don't have, but is any payments made for dismissal or separation. So these are the payroll costs. These are what's eligible for figuring your costs, because we got to come up with that 2.5 times number, which is going to give us the amount of loan that we're going to request. What is not included? What's not included is employee or owner comp in excess of $100,000. So it can be up to $100,000, but not over. And this includes benefits that are paid. So the $100,000 may not actually include just salary. So if you have an employee who, let's say, is making $95,000 a year, but between retirement plan contributions and benefits that you're paying, they could be over $100,000. But the cap is $100,000 per employee and owner. It also includes federal employer payroll taxes. And right now, the bill has a provision in it that includes a code section that makes employee withholding also part of what is not eligible for your calculation for payroll costs. We're trying to get clarification on this. Again, we're not sure, but we don't believe that it should be appropriate for employees' taxes to be reducing the loan, but this is how it's been written so far. Employees who live outside of the U.S. are also not part of the eligible payroll calculation, and qualified sick and family leave payments under the Families First Corona Response Act are also not part of eligible payroll. So now we've got our eligible payroll. We know that it's going to be 2.5 times, and we're going to calculate that amount. We are working on an Excel schedule that we will hope to be able to share with you shortly once we get clarification on these rules, that you'll be able to put in the numbers and be able to determine what your loan request should be in order to hopefully maximize the forgiveness portion of the PPP loan. However, you need to know also how you can spend this money. So the PPP proceeds can be used for your payroll. It can be used to pay your employee benefits, like a healthcare premium. It can be used to pay also interest on any long-term debt that you might have, including mortgages. It can be used to pay your rent, and it can be used to pay your utilities. Utilities include electric and telephone and internet service, so that would be part of your utilities. And when you receive the money, you're going to have 8 weeks to pay for it. So from the date of funding, from the date that you get the money, you have 8 weeks to spend it to pay for these qualified expenses. So that's one part of meeting your obligations to have forgiveness. Now, how is the forgiveness going to be calculated? Well, the first element we talked about is all the costs that you pay during the 8-week period compared to the previous year or time period proportionate to maintaining employees and wages. Okay, that just kind of like sounds crazy. Simply put, is that you have to meet your costs as they are outlined, and then you also have to have a full-time employee requirement. Well, that means that if you look at the bottom of the slide, if you have the same number of full-time equivalents at the beginning of the covered period, which is February 15th, 2020, and you have the same number of full-time equivalents as of 6/30/20, and you have used all your funds for qualified expenses, then you should be able to get forgiveness. Now, no less than 75% of the loan can be used for payroll costs, no less. That leaves you some money left over that you can use to pay for the other expenses that they outlined, which were interest on debt, which was utilities, which was also rent and employee benefits and payroll. Also, the number of employees cannot be reduced by more than 25% during this time. And employee wages under $100,000 can be reduced by no more than 25%. So if you have an employee who's making $60,000 a year, you can reduce the compensation by no more than $15,000 for them. And now you're kind of wondering, well, why can you reduce compensation? Well, in many cases, these employees will not be working. And the purpose of the PPP loan is to keep the employees on payroll even though they're not working. So it is possible for you to pay them less than what their normal wage is, but you cannot reduce that wage or that compensation by more than 25% for employees making $100,000. Okay, now, if you pay an employee more than their monthly earnings that go in excess of an annualized $100,000, any of that part of the loan will not be eligible for forgiveness. What are the terms of the PPP loans? Well, as you can see on my next slide, there is a crossed out area. Today is April 2nd, and on March 31st, we got an update to what was in the bill. So what I crossed out there was those loans were going to be paid over 10 years with a 4% interest rate, no fees, no prepayment penalty, and the SBA would be paying the banks any fees that were involved, so it wouldn't cost you anything. And it was possible for these loans to begin payments anywhere between 6 and 12 months after funding. So that's kind of all changed right now. So for any amounts that are unforgiven, the maximum term is going to be 2 years with an interest rate of 0.5%. And there will be no prepayment fee. So you can always, if you didn't spend the money, you can just give it back and you'll just pay that 0.5%. And the SBA will pay a fee to authorized representatives preparing the loan application. So that's the term of the portion that's not forgiven. Here's some additional information that you probably need to know about these loans. You are going to apply for the loan through an SBA 7A certified lender. Those are usually the banks that you're probably doing business with right now. And we do recommend that you use your current bank and the current banking relationship that you have. The reason is because you want to make sure that this application gets processed as fast as possible. There is an anticipation that the system will be overwhelmed and that the $349 billion allocated to this loan program will be used up by mid next week. That's the projection right now. We're not sure if it will get refunded with government money to continue the program, but at this point, all anticipation is that the money will be used up. So that's why it's important to make sure that your application is ready to go into the system so that you can get your funding. Now, it's my understanding, and I guess Joe Quinn from PNC will be able to confirm some of this, is that the banks will start with the larger employers first. So remember that these loans are available up to employers who have up to 500 employees. And in this case, they're going to start with 500 and work their way back down through all of the different ranges of employees. So those of you who are smaller employers are hoping that there's still money left over to get there, or maybe you can try and influence your banking relationship to try and get your application pushed through earlier. When you need to obtain forgiveness, you're going to go back to the banker, and there's going to be information that they're going to request so that you can prove that you use the money for appropriate purposes, that you had the right number of full-time equivalent employees at the beginning and at the end of the period. One of the things we also recommend is that you open up a separate bank account and that you put the money from the PPP loan into that separate bank account so that it is easy for you to track your expenses. This way, if you're paying your payroll out of that one account, if you're paying your utilities out of that account, any mortgage or long-term debt interest, it's all in one place, and it makes it very easy to gather the information so that you can apply for that forgiveness and also show the banker how the money was spent. This is important to know, and that is there is no recourse against anyone for this debt. So an eligible recipient does not have to worry about having to pay this money back as an individual if they're unable to pay. And that's a pretty big part of this loan. So I hope that you'll be able to apply. Hopefully you'll be able to get funded, and then you'll be able to account appropriately so that you can get as much of this loan forgiven as possible. There has been questions about applying for both loans, and the answer, both loans meaning the EIDL as well as the PPP, and the answer is that you can apply for both. However, what will happen is that your EIDL loan will be refinanced into your PPP loan. You can use your EIDL loan to pay money, but you can't use it to pay the same expenses that you are paying under the PPP loan. They have to be completely different expenses, but they still have to be expenses qualified under the EIDL loan. So here's some things that you need to consider when you're looking at whether you should apply for the loan. So the first question that you should be asking is, do I need the cash now? Am I going to run out? Do I not have enough to carry me for a period of time? And if you believe that you need the cash now, that is a part of the decision-making tree that says you got to apply for this loan as fast as you can. And let's worry about the forgiveness part later on. Do you have enough cash to pay expenses for a month or more? And the reason why I give this question for you to consider is because if you were to apply for the loan now, it's quite possible that you could get funded in the next week or two. You have 8 weeks to use that money. And that money in 8 weeks will take you to early June. However, if you remember, you need to have the same number of full-time equivalents working, making at least 75% of what you were initially paying them as of February 15th. That can put a stress on your cash flow unless you have the money to be able to pay them at the end of the loan. Now, there is some question about releasing the loan, and I've heard as long as 4 months, you can ask the bank to hold it. I've heard 4 weeks, and we're going to let Joe Quinn answer that question when he has his opportunity to share with us what's happening, so that you know how long you can ask the bank to hold the PPP funds. The other question is, can you predict when you're going to be able to reopen? Because if you can reopen 8 weeks from today, then you could probably be generating additional revenue to help you to pay your expenses for that last month of June. Will you be able to meet all the requirements of the PPP forgiveness portion? If you're not able to meet all the requirements of your PPP forgiveness portion, that's okay. But you should just know that you may have a loan obligation. Will the EIDL money come after you receive PPP loans? Because if the EIDL money comes after, it's going to get repackaged into the PPP loan and will probably create some debt that's not going to be forgiven under PPP. And then the other question to ask is, maybe the EIDL loan might be better, or maybe the PPP might be better, or maybe both works for you, or maybe you don't want to do this at all. There is an employer retention credit that is available for payroll taxes, and that employer retention credit, which I believe Sean will probably address under the CARES Act, will create a conflict because you can't get PPP funds and claim the retention credit. And so these are all things that you need to consider. Everybody's going to have a different situation, and I'm sure you're going to have a lot of questions, and I hope that we can give you answers, as this is still a very fluid situation. But there are some things that we do have a little bit more understanding about, and that Sean is going to share with you about some of the provisions that have come out in the CARES Act. Sean?
Thank you, David. All right, like David said, we're going to be talking a little bit about the CARES Act. Now I'm going to focus on really three main highlights of this, ones that we feel are most important to you, our clients. First is going to be the changes to retirement plans, then the changes to unemployment compensation, and then the last big one, something we're all curious about, the stimulus payments. When are we going to get them? All right, so first, the impact on retirement plans. Now, the idea behind the changes to the retirement plans made under the CARES Act was really about getting money into the hands of the participants who needed it and waiving any 2020 required minimum distributions for people that didn't need the money. So now on to the changes. So for cash balance and other defined benefit plans, contribution due dates for the 2020 calendar year have been extended to January 1st to 2021. There's also been changes to the method of determining the minimum funding requirements for the 2020 plan year. So in general, this act will allow plan sponsors to offer distributions that may otherwise not have been available under those existing plans, as well as tax relief on any distributions from those plans. So keep in mind, while these kinds of distributions are available, plan sponsors are not required to allow these distributions out of the plan. However, if they do allow them, any plan documents may need to be amended, and we're going to recommend that you contact your third-party administrators for that. So for individuals to be eligible for COVID-19 related distribution relief out of any retirement plan, an individual must be impacted by the coronavirus in some way, whether it be themselves, a family member directly or indirectly. So onto the related distribution. So participants of tax-favored employer-sponsored plans and IRAs may take the COVID-19 related distributions during the calendar year 2020 of up to $100,000. That's the limit. So keep in mind that these distributions are still includable in taxable income, still subject to taxation, but the 10% penalty for early withdrawal under the age of 59 and a half does not apply here. By default, that income will be recognized over a 3-year period, but there is an election available for people to recognize all of that income in 1 year. Also, keep in mind that these distributions are not subject to mandatory federal income tax withholding rules. So now on to changes about plan loans and repayment of those loans. So an individual who receives a distribution has up to 3 years to roll all or any portion of that distribution back into the account. Now, if this is done, they may amend the return and receive a refund for any taxes paid on those distributions. So for repayment of loans, so for 180 days following the enactment of the CARES Act, standard loan limits have been increased from the usual minimum of 50% of the vested balance or $50,000 up to 100% of the vested balance or $100,000. Now, payments on existing loans between March 27th to December 31st, those may be postponed for up to 1 year. Interest is still going to accrue. The loan balance will still need to be re-amortized at that point, but that option is available. Okay, so next part of the CARES Act we want to discuss is changes to unemployment compensation rules. So this act both broadens the eligibility for unemployment benefits as well as increases the amounts that are being given out. So first, expanded eligibility. So this new provision provides up to 39 weeks of unemployment benefit assistance to covered individuals who are either wholly or partially unemployed as a result of COVID-19. This also extends eligibility to those who otherwise would not have been eligible for benefits. This now includes independent contractors, self-employed individuals, those who have a limited work history. It also provides benefits for those who have exhausted all regular unemployment compensation that they've received under either state or federal law. So in order to obtain these expanded benefits, individuals must be able to self-certify that they are able and available to work, that they are either partially or wholly unemployed or unable or unavailable to work if they have been directly or indirectly impacted by the COVID-19 crisis. So keep in mind that individuals who are able to telework or work from home with pay, or who are receiving paid sick leave or other paid benefits, including those under the recent FFCRA that Kathy described earlier, those are not eligible for the unemployment compensation under this act. So now the increased amounts under this new provision. So under this act, benefits have been increased in amount as well as extended in time. Individuals who receive unemployment compensation will also receive an additional $600 per week on top of the ordinary state authorized weekly benefits that they are now eligible to receive. This specific benefit, however, keep in mind, is only available to July 31st. So after that, no more extra $600 a week. So in addition, the government will also fund up to an additional 13 weeks of what they call pandemic emergency unemployment compensation for those who remain unemployed after they've exhausted all the benefits we described above. This will go up to a maximum of 39 weeks and will be available in effect until December 31st of this year. Let's see, so in addition, it's also important to keep in mind that some states, including New York and New Jersey, have adopted new requirements related to unemployment compensation in response to the COVID-19 crisis, so it's important that you explore those as well. So the last part, I'm sure we all want to hear about, stimulus checks. Lots of questions going out around these. How much are we getting? When are we getting them? How often are we getting it? The idea here is to try to answer some of those questions. So the first question is, how many payments are we going to get? So as the act is written right now, everyone's receiving, who's eligible to receive it, is receiving one payment. That may change in the future if future stimulus bills are necessary and put in place, but as of right now, it's just one payment. So the second big question that has come up is, how much am I going to get? So it's important to know that this is a detailed calculation, and that's going to apply for some people and not for others. So we start with the base of $1,200 for individuals, and if you are married and you file jointly, that's going to start at $2,400. Now, if you have children that qualify for the child tax credit, which means they're under 16 years of age, you're going to receive $500 for each child. So there are phase-out limits for these stimulus payments. So, for example, if you are single, the amount that you're going to receive will start to drop off with an adjusted gross income over $75,000, and it will cap out and completely disappear once that individual has hit an AGI of 99,000. So for those who are married filing joint, that phase out starts at 150,000 and will completely disappear at 198,000. For those who file head of household, that number starts at 112,500. So next question is, how is the government calculating all of this? So in general, they're basing this on the most recent return that you have filed. For those that have already filed their 2019 returns, that's the information they're going to use. If not, they're going to base it off of the 2018 returns. Now, a question came up within the last couple of days of, how are they going to determine that if we have someone who doesn't file just because they receive Social Security benefits? The answer to that is that individuals who receive Social Security benefits, their information is already on file with the government, so they're going to be able to have those benefits without really having to file a return. Now, it's also important to remember that the Treasury is in the process of putting in place an online portal that will allow individuals to enter direct deposit information if they have not already included it on a past filed return. So the last question, the most important one, is when are we going to get these? So for those people that have filed the 2019 returns, they have updated direct deposit information on file. It could be as soon as 3 weeks. Past that, if you don't, you're going to be receiving a paper check. It could be up to a couple of months. So hopefully we all get these as soon as possible. All right, so that was the CARES Act, or at least the important parts of it. So we're going to move on to David for some Q&A.
Thank you, Sean. So I hope you're still with us. You're not overly overwhelmed, but I'd like to ask Joaquin if you could unmute. And we're fortunate to have him here. We're pleased that we have such a great relationship with PNC Bank. And I'd like to invite Joaquin to share with you a little bit about the application process and how this is starting to unfold. Joaquin.
Thanks, David. Good afternoon, everyone. And so I just want to start by saying that really a lot of the process, just like David alluded to, and everyone has been chiming in, is it's certainly a very fluid situation. Things change on a daily basis. I've been paying close attention to the presentation just because I think the information being given is extremely helpful, and just being prepared for what will likely be needed when the application is live and ready to go. So I've looked at some of the questions as well, and I'll try to get through some of these, David, because I think they do relate to the PPP piece and the application. In general, I'll start with one of the main questions that I've come across is some institutions have applications ready, others don't. What does that mean, and can you fill that out? I'll tell you that every major institution who's an SBA lender, they have their own application, right? The application that was floating out there is an SBA application, which certainly helpful to guide you and prepare you for what will likely be submitted come tomorrow. But the application per bank will be live tomorrow. Even if you filled out an application and gave some information to some lenders out there, they are not able to submit anything for a decision until tomorrow. So I just want to make sure that everyone understands the program is not live for an actual decision until tomorrow. The other piece I wanted to answer is there's several questions just around who is best to take the application. Should someone apply with multiple institutions? I'll say in general, the best course of action is to apply through your bank that you currently have your accounts with. And the main reason for that is every lender is prioritizing their existing client base, but more importantly, it's because they have that business information already on file, that when it comes to regulatory concerns and making sure that the business is already vetted as a legal entity, that's already done, right? It doesn't mean that a bank will not take an application for someone who doesn't bank with them. If push comes to shove and that has to happen, they will certainly do it, but it will delay the application. It takes a lot of paperwork on the front end, as I'm sure all of you know, to open a new account, to provide documentation proving that your business exists, et cetera, et cetera. So it's certainly something to keep in mind, because once you go live tomorrow, that's going to be extremely important. What I thought I'd do, and David, let me know if this is the most efficient way, just because I think there are a lot of questions so far. I see 16 here that are open. Start going through some of these, and hopefully the answers probably encompass most of your attendees. Does that work?
Yeah, this would be great. I really appreciate whatever you can share. Give any guidance would be great. Thanks.
Sure. So I'll start with Joel Singer. So I know the first question that came up before our call kicked off here was regarding delayed funding. I'll tell you, you can't speak on behalf of other banks, and it's certainly something you should double check with whomever manages your relationship. But the consensus that we've gotten is that there really isn't a method to choose a start date for funding. And I'll say something that the $349 billion allotted to this very, very likely is going to be exhausted within the week. And so a lot of people have asked about holding off on applying. They're not sure if they want to go ahead and take that. I'll say in general, every business in America should strongly consider applying for the program. They should do it as soon as it's available. And whenever the approval happens, because it may not happen in the same business day, the expectation is millions of applications will go in tomorrow. So whenever that decision comes back to you that the request was approved, the idea is by 3 weeks, you will receive the funds from your approval. And then whatever you use it towards your payroll costs and the other costs that David mentioned, which are debt interest payments, rent/lease payments, et cetera, utilities, those things. If you use your dollars towards those expenses, you're essentially being told through numerous sources that those dollars will be forgiven. And if there is an excess and there is not a need for that excess, you can certainly pay off that balance at 0.5 point of interest. I think it just makes all the sense in the world to just have that cushion. And so actually, David, I'll expand on that one more little bit there. If you have not had a conversation with your banker yet, that's one of the key things you want to make sure, but also understand that a lot of institutions are being more prudent on providing additional credit. There are a lot of unknowns in this environment that we're in. We don't know when doors are opening again. We don't know when practices will be stabilized once doors do open again. So do not rely solely on past credit history, past credit approvals to help fund you when doors open. Absolutely take advantage of the EIDL program and the PPP program while it's available. Not only are the rates extremely favorable, but I think the idea here is to just really keep people employed, pay them, have them able to manage, their piece. And as business owners, that's certainly one of the things that we're hoping gets done. Looking at Maximilian's question about 1099 contractors. LLCs owned by members who are S corps. I'll defer that over to you, David. I mean, my interpretation here, as far as just affiliation and what's happening with business size, as long as the overall business, once they're connected, does not exceed the parameters set forth by the bill, you qualify to apply. So hopefully that answers that question. Will you be able to pay 1099 contractors under this PPP loan? Yes.
Joe,
that is
Joe,
our understanding. That's what's been. I'm sorry. Go ahead, David.
No, it's great. You're gonna get your CPA soon. So let me just elaborate a little bit on the question about the entities with different ownership. Yeah, it's treated as one entity, as you mentioned. We've had that question come up in various discussion groups that I'm participating in, and the consensus is that you use the attribution rules. And yes, you can use 1099 contractors. We've had a couple of questions on that. The 1099 contractors are limited to the same compensation that an employee would be limited to. However, let me just caution you on 1099 contractors, because a 1099 contractor who may be working for a business, it's quite possible that they may be working at other locations and may be eligible on their own to apply. But if they're just working for you under a 1099, then our recommendation is to include them. And even if they're really not working for you under a 1099, only exclusively for you under 1099, include them anyway, as long as you use that money to pay payroll, and you have those same number of full-time equivalents in place at the beginning of the period and the end of the period, from our perspective right now, we see that as it's okay to include the 1099 contractors in your calculation. Sorry, go ahead.
Sure. And I think actually, David, you just answered the following question, the follow-up questions that Maximilian had around the limitations, right? All those limitations do apply, so keep that in mind when you're looking to pay those same folks who are part of the ownership. Daniel Sharp asked around timing the application. Going back to the original question, as of right now, there is no institution that has really communicated that there's an ability to time the application. I mean, at this point, the first step is make sure your application is in tomorrow when it's live, that it's submitted right away, and that ideally there's an approval within the business day or 2 business days. And again, that's just being fluid. I mean, that's the expectation. And because there's no underwriting involved, we're hoping that that accelerates the decision to get an approval to you once you apply. Let's see, Cheryl Levine asked around. Yeah.
There's a question about applying for the PPP now, and then applying for the EIDL in whenever they need it in the future. I believe the EIDL money is available through June 30th. Is that correct?
That's my understanding. Yeah, and they'll likely extend that just because this doesn't have an end date, right? And a lot of people are asking that same question. My piece, and I've given this advice to every client of mine, apply for both. When you get approved for EIDL, for example, unlike the PPP, you do have time to make a decision on accepting their funds, because that is in fact a loan and it's not a grant. So you can have an approval, you can have that approval sit until you make that decision. My recommendation, if you have not applied already, absolutely put that in there. The fact that you have principal and interest deferred for 12 months and a maximum term of 30 years on the loan, extremely favorable. So that has been our advice time and time again.
Okay, great.
Let's see. So we have the Cheryl Levine's question. If you made the deadline, you will get the loan forgiven. Yes, I mean, that's the idea. As long as you have the right documentation to show where those dollars are going, the law states that those amounts will be forgiven. So certainly documenting where those dollars go is extremely important.
Yeah. We'll come back to the unemployment question. Yep. Then there is, let's see here. Somebody said here, any questions, Jack, that you want us to answer? Let's see.
I'm looking to see what the next PPP question is. There's one here. Yeah. Do you need application only and then docs to follow, or need backup docs now? I'm not sure exactly what you mean by backup docs now. I'll tell you that the application, there are checklists, and there's a variety of checklists that have been circulated that basically talks around having payroll reports ready, IRS quarterly reports ready, additional documentation around retirement plan funding, which you can certainly work with David and your advisor on collecting what those documents look like and submitting that as part of your application. There may be additional documents necessary when you submit the application. That's something that today all lenders are going to clarify before they go live. But at the very least, that's a starting point for what you need to provide to get it approved. And then for forgiveness, it's just keeping track of how you're dispersing that money.
So 2 questions for you. In terms of opening up a new bank account for the PPP fund, do you recommend opening up the account now to have the money dropped into that account when it's available?
So I'll say that, because our call center, our branches, and all relationship managers are primarily going to be tied up with these requests. Having a new account is something that could be helpful just from an organizational perspective, just to have it all lined up. In my opinion, it's not totally necessary, and you actually may take a little while for you to have that account opened because of the, just the capacity issues that we have right now with most banks. But if it's something that you feel is an easy way to sort of have the funds deposited into, and also an easy way for you to track on money's going out, then certainly it couldn't hurt.
Okay,
I would
great.
do it today, actually, if you have a chance. I know it's 2:30 in the afternoon, but if you can do it, then definitely do it today.
Look, the number of attendees just dropped by 30. Is there a time limit for spending the EIDL grant? My understanding is, and you can correct me if I'm wrong, is that money is supposed to be used immediately for needs, and it has a required spending purpose to it. So my expectation is, yes, use the EIDL money first before you go back into dipping into your own funds. Would you answer that any differently, Joe Quinn?
Actually, could you rephrase that, David? Because so you're saying with EIDL funds to use it for what expenses particularly?
Just the EIDL grant, the $10,000.
Oh, the EIDL grant. Yeah. So I know you mentioned this earlier, where the $10,000 grant that's the only piece of EIDL that's connected to PPP, because the forgiveness amount, whatever that amount lands at, is going to subtract that 10 grand because it is a grant. If you're able to hold on to that and wait for the PPP funds to come in, then certainly do that. Is that answering your question, David?
Yeah, that's the question.
Yeah. Okay.
And then another question we've gotten is, what happens with the $10,000 grant in relationship to the PPP loan? My understanding is that $10,000 grant gets packaged into the PPP loan. It doesn't get packaged into the PPP loan, but what it does is it reduces the amount of forgiveness, which means that you're not going to have 100% forgiveness. Is that correct?
That's exactly right. So let's say you got a $10,000 grant and your PPP funds was $100,000, and you used it in the way that it's meant to be used. You've tracked all your expenses, and you would typically qualify for the full $100,000 to be forgiven. What'll happen is they'll subtract the 10 grand that you already received through EIDL. So in essence, you're getting 90 grand forgiven off of the 100,000 that you were given through PPP.
Right, and that means that you'll have like 90% could be for forgiveness, and the rest would have to be repaid.
Correct.
Okay. Another question is about having multiple entities. If you had 100 entities, can you apply for the EIDL grant for each of them? My understanding is that yes, you can.
Yes, that's our understanding as well. As long as they are separate tax ID numbers, separate entities, then yes, you can do that.
Right. Okay. Let's see what else. There's a question here about somebody who doesn't have medical insurance, but they're paying for AFLAC policies. And I believe that those would be covered under the employee benefit terms as health benefits and health premiums. There are two separate items distinguished in the law, so I'm guessing that should be okay. They don't go in depth into defining what the health benefits are, but those were examples that they gave. And so an AFLAC policy sounds to me like a health benefit. We've got a lot of questions about unemployment, and I'd like to take a moment to address as many as I can, hopefully with a little description of what's happening with unemployment. So my understanding right now is that unemployment is available to independent contractors, to sole proprietorships, and to anybody who is considered to be self-employed. New Jersey seems to have indicated that if you make application and you've been impacted, your income's been impacted by the current crisis, that you're eligible for unemployment. However, it is still not clear to me if business owners who go and apply for unemployment, so if you're the owner of an S corporation or you are a partner in a partnership, are you going to be eligible for unemployment? And I'm not exactly clear, but my answer is to anybody who feels that they think they might be able to obtain unemployment is to apply. You can make a submission, and if you get denied, they'll explain to you why you get denied. New Jersey and New York and other states all have different rules regarding unemployment, but this is my understanding for New Jersey. I think there was another question about 1099 regarding being commission-based 1099. You're still calculating your eligibility for the 2.5 times your monthly payroll cost, the average monthly payroll cost, and you're going to be using the period of 2019, most likely. Oh, that's a question I want to ask you. Most likely, let's assume it's 2019 until Joe Quinn tells us differently. Then you had commission 1099 people during that time period. Those commission 1099 people will have their average calculated into what's available for you in terms of that 8-week period of funding. Now, if you're not paying them anything because they were commission-based, you still need to make sure that you are covering more than 75% of the PPP funds are going towards payroll costs, and that you still have the number of full-time equivalent employees at the beginning and the end. Now, Joe Quinn, do you know what period of time the requests are going to be on that payroll average? Is it going to be from March of 2019 to February of 2020, or is it going to be just 2019?
For non-seasonal businesses, what they're doing is they're taking the 12-month period, including your most recent payroll date, and they're putting an average together off of those 12 months.
Okay, so it's not as simple as just taking the 2019 numbers at this point.
It isn't. That's the interpretation we have for non-seasonal businesses.
Okay. All right. We've gotten questions about laying off employees. We've always encouraged people to lay them off. You can always bring them back to make sure that you meet that full-time equivalent standard for the forgiveness of indebtedness. Okay. We have definitely exceeded our hour, and we do have a lot of questions. We're going to try and answer the questions. We still have about 20 of them still open and growing every second, but we're going to try and get back to you. I want to thank Kathy. I want to thank Susan. I want to thank Sean, and I especially want to thank Joe Quinn for joining us to help provide some clarification on the new rules, and to let you know that LB Goodman is here to help you with the process. We're here to answer your questions so you can get clarity on making decisions about how to proceed going forward. And at this point, I want to say thank you, and I wish that you all stay healthy, and that when this is all over, we have the opportunity to do this in person. Continue to watch your email for updates as they happen, and please visit our website. We have a coronavirus resource page. You'll see it on the top of the landing page. It says COVID-19 Health. And thank you very much for joining us. And we have a last slide for you with some information about our firm. We have a last slide, Jackie. So thank you very much. There's our phone number, our contact information, our general email box for any questions that you didn't have time to respond to. Thank you all. Thanks for joining us.